If your student loan payment just jumped and you are trying to figure out how to get it forgiven, how to push it back, or how to stop them from taking money out of your paycheck, there is something you need to know before you do anything else. Almost every piece of advice you are about to find online was written before July 1st, 2026. And on that date, one number quietly became the switch that controls your entire situation. It is not your balance, it is not your income, it is not your credit score. It is the date your newest loan was first disbursed. By the end of this video, you will know exactly which forgiveness programs you actually qualify for, how to lower or pause your payment without wrecking your progress, what to do the moment a garnishment notice arrives, and which 5 moves are permanent mistakes you can never undo. I'm going to give you the real regulations, the real numbers, and the real deadlines. And near the end, I'm going to tell you the things nobody knows yet, including me, because on a topic where being wrong costs you money, pretending to have every answer is how people get hurt. Here is the thing I want you to hold on to. The mistakes that cost the most money in 2026 are not the reckless ones. Nobody is getting destroyed by ignoring their loans. They are getting destroyed by doing something that looks responsible. I will show you exactly what I mean, and it is going to surprise you. Let me introduce you to Marcus. He is 41, he has been paying on his loans since 2009, and last month his payment went from $812 to $3,505. That is not a typo, and it is not unusual right now. Marcus did what any sensible person would do. He went online, read that he should consolidate his loans to get into an income-driven plan, and started the application. That single action, if he completes it, will cost him more money than every other decision in his financial life, and it looks like the responsible thing to do. So before anything else, do this. Go to studentaid.gov and log in. You will need an FSA ID. If you have never made one, there is a Create Account button right on that page. It takes about 10 minutes, and you need your social security number and an email address. If you cannot get in at all, call the Federal Student Aid Information Center, and the number is in the description, and ask them to read these numbers to you over the phone. Then open the page called My Aid and write down 4 things. First, the first disbursement date of every single loan you have.
Disbursed means the day the money was actually paid out to your school, not the day you signed anything, and not the day you started paying. Second, whether any loan says default. Third, the type printed next to each loan, whether it says Direct or FFEL or Perkins, because several rules in this video work differently for each one. Fourth, the name of the repayment plan you are on right now. Half of what comes next branches on those 4 facts, and if you do not have them written down, you will be guessing for the rest of this video. While you are in there, fix your mailing address, because every deadline in the collection system runs from a notice mailed to your last known address. And if that address is 3 apartments ago, your clock is already running and you do not know it. Now, here's why that first disbursement date matters so much. There is a federal regulation, 34 CFR 685.209, and buried in subsection D5 is a sentence that reorganizes everything. It says that only direct loans made before July 1st, 2026 may be repaid under the PAYE, IBR, and ICR plans. Read that again. And here is the part everyone gets backwards. It is not about the loan you are worried about. It is about your newest one, and it is about you. The regulation asks whether the borrower has received any loan on or after that date. If the answer is yes, the old plans close for you, not just for the new loan. The rule is written into the plans themselves. Standard, extended, and graduated are each defined for borrowers who have not received a loan on or after July 1st, 2026. And there is a plan built specifically for the person holding both an old loan and a new one. It is called the Tiered Standard Plan, and landing on it is the tell that this rule has caught you. If you have any federal loan first disbursed on or after July 1st, 2026, then income-based repayment, PAYE, income contingent repayment, extended, and graduated are gone permanently for every loan you own, including the undergraduate debt you took out 20 years ago. Your only income-driven option becomes the new Repayment Assistance Plan on a 30-year clock. And here is the part that catches people. A brand new Direct Consolidation Loan counts as a new loan. That is Marcus. He has old loans from 2009, which means he currently has access to the entire menu. The moment his consolidation disperses, he is holding a loan made after July 1st, 2026, and income-based repayment ends for everything he owns. His income-based repayment clock is 25 years because he had a balance before July 1st, 2014. If you first borrowed after that date, yours is 20. Marcus is 15 years in, so he has 10 years left. The new clock is 30 years, starting at 0. He would be trading 10 years for 30. That is not a delay. He just added 20 years to his own life. So let me say this as plainly as I can, because it is the most dangerous advice currently in circulation. The Department of Education's own guidance said it directly. If you must consolidate your loans in order to access the IBR, ICR, and PAYE plans, then you must have your consolidation loan disbursed no later than June 30th, 2026. That window is closed. It closed before this video existed. Every article, every video, every forum comment telling you to consolidate your FFL loans or your Perkins loans or your Parent Plus loans to reach an income-driven plan was true when it was written, and is now the single most destructive action available to you. If all of your loans predate July 1st, 2026, you still have the full menu, and your primary job before anything else in this video is to protect it. Do not take a new federal loan. Do not start a new consolidation. Both convert you permanently. There is one more version of this trap, and it is aimed at graduate students, so listen closely if that is you. Under Regulation 685.200, a student already enrolled as of June 30th, 2026, who had a direct loan for that program before July 1st, can keep borrowing Grad Plus through their expected time to credential. It is written as a favor. It is called a transition exception. But nobody has connected the two halves of it. Taking that loan gives you a first disbursement after July 1st, 2026, which converts your entire portfolio, including the undergraduate loans you have been paying on for a decade. The exception that lets you keep borrowing is the same act that ends income-based repayment for everything you own. And if you are a parent who borrowed for your child, I need to be direct with you, because the advice aimed at you is the most out-of-date of all. Parent Plus loans have never been eligible for income-driven repayment on their own. The workaround everybody used was to consolidate them and then enroll in income-contingent repayment. That workaround ran on the same June 30th, 2026 deadline as everything else. If your consolidation did not disperse by then, you are looking at the tiered standard plan, and there is no income-driven forgiveness attached to it.
I am not going to soften that part. A consolidation that repaid a Parent Plus loan is what the regulation calls an accepted consolidation loan. And accepted consolidation loans are locked out of the Repayment Assistance Plan, while that consolidation, because it is itself a loan made after July 1st, 2026, is what closed income-based repayment, PAYE, and income contingent repayment for you. That is the same rule from the top of the video, arriving in your file. There is one door left, and it is PSLF. It opens only if two things are both true. 1. You work full-time for a government agency or nonprofit. 2. You owe less than $25,000. Here is why that second one decides it. PSLF counts a month when your payment is at least as big as it would be on the 10-year standard plan. Your 10-year standard amount is simply what your bill would be if you paid the whole balance off over 10 years, and you can see it on your studentaid.gov dashboard. Almost every rule from here on measures against that one number, so go find it. Under $25,000, the tiered standard plan pays on a 10-year schedule too, so your payment clears the bar and your months count. Above $25,000, the term stretches to 15, 20, or 25 years. Your payment drops below the bar and the months stop counting. So if both of those are true for you, your months count and it is worth filing. If either one is not, they do not count, and there is no forgiveness clock waiting for you. Put your energy somewhere else in this video instead. If you consolidated in time, there is a further requirement that you make at least one qualifying payment inside a window that closes June 30th, 2028, and the department has said it will publish more detail. Do not wait for the deadline. The operational cutoff may land earlier than the one printed in the regulation. Now, if you are on the SAVE plan, your situation has its own clock, and it is personal to you.
SAVE was vacated by a federal court on March 10, 2026. Interest has been accruing on those loans since August 1, 2025, and months from August 2024 forward earn no credit toward income-based repayment forgiveness. The department began issuing 90-day notices on July 1, 2026, and it staggered them. That last word is the important one: staggered. There is no national deadline. I have seen videos put a single date on screen, and that date is wrong for most of the people watching. Your 90 days runs from your notice, not from a calendar. So go find your notice.
Check your email, check your servicer's message center, check your physical mail, because if you do nothing, you are not left alone. The department places non-responders onto the standard or the tiered standard plan, and neither of those is income-based at all. For the 27% of SAVE enrollees who are paying $0 a month, that is the entire story. They go from zero to a full amortized payment because they never opened an envelope. Now let me talk about the Repayment Assistance Plan honestly, because it is the plan the government is steering everyone toward, and almost nobody has explained how it actually works. RAP is 360 payments, 30 years. Compare that to income-based repayment at 20 or 25 and understand what is being offered. RAP does not lower your payment so much as it lengthens your sentence by a decade. The payment is 1 to 10% of your adjusted gross income. Notice what is missing there. There is no poverty line protection. Income-based repayment uses discretionary income, which is your income minus a protected amount, and it can genuinely reach $0. RAP applies its percentage to your whole AGI, and it has a floor of $10. There is no zero payment under RAP. This means something counterintuitive. If your income is low, you will frequently pay more under RAP than under income-based repayment. The plan marketed as assistance is often worse for the people who need assistance most. If your income is high and your balance is small, watch out for the reverse problem. Income-based repayment caps your payment at the 10-year standard amount. RAP has no cap at all. RAP does have two real benefits, and they are worth knowing. You get $50 per dependent knocked off your payment, and there is an interest waiver plus a $50 principal match each month. But here's the trap nobody mentions. If you pay extra, you advance your due date, and Regulation 685.209 subsection 03 says that for periods without a due date, you are ineligible for the interest waiver and the principal match unless you opt out. Paying extra, the most responsible-sounding behavior there is, silently switches off both benefits. And one more thing about RAP that matters enormously if you are chasing forgiveness. Months you spend on RAP do not count toward income-based repayment, ICR, or PAYE forgiveness, unless your RAP payment was equal to or higher than the 10-year standard amount. So 2 years parked on RAP can burn 2 years of the 20 or 25-year clock we just talked about. The asymmetry runs one direction only. Income-based repayment months do count toward RAP's 360. So which one? 3 questions. Are you already deep into an income-based repayment clock? Then RAP is expensive. Is your income low? Income-based repayment probably pays you better. Is your income high with a small balance? Income-based repayment caps. RAP does not. Now, public service loan forgiveness. If you work for a government employer or a 501c3 nonprofit, this is your track. And there is very good news that a lot of people have not heard. In October 2025, the department published a rule that would have let it disqualify an employer for what the rule called a substantial illegal purpose. On June 30, 2026, a federal court in Massachusetts struck it down. The decision says the rule was contrary to law, promulgated in excess of statutory authority, arbitrary and capricious, and a First Amendment violation. The final line is, quote, "The final rule is vacated." It was struck down 1 day before it was going to take effect. The department's own PSLF page now says it cannot enforce those changes, and that employer certification language about illegal activities will have no effect. If you work at one of those nonprofits, you are fine. I want to flag something here that matters for how you use the internet on this topic. The regulation you can read online right now still contains the struck down text. Government publication lags court orders, so if you go read the rule yourself, or if you ask an AI about it, you will get language a court has already thrown out. Reading the regulation without checking the litigation gives you a confidently wrong answer. Here is what actually kills PSLF applications, and it is not eligibility. The department's own reporting shows 1,043,300 form closures for incomplete applications, and 230,000 forms sitting right now waiting on nothing but a missing signature.
Meanwhile, 351,800 people are sitting between 97 and 119 qualifying payments within 2 years of the finish line. And 1.25 million people have already had $93.4 billion discharged. The program pays. People just do not file the paperwork correctly. So confirm you are on a qualifying plan. Every income-driven plan counts, which means RAP, income-based repayment, ICR, and PAYE. So does the 10-year standard, and so does the consolidation standard plan when it carries a 10-year repayment term. And there is a third door that most guides leave out completely. Any other plan except the alternative repayment plan counts in any month where your monthly payment is equal to or higher than what you would have paid on the 10-year standard. So, if you are on graduated or extended, do not assume those months are worthless. In the later years of a graduated schedule, the payment climbs past the 10-year standard figure, and those months can count. Pull up the standard plan payment on your dashboard and compare it to what you are actually paying before you write those months off. Submit the PSLF form through the Help tool for every employer and every period every year, because your count only moves when you file. And on consolidation and PSLF, let me correct something you have heard. The old warning was that consolidating resets your payment count to 0. That is out of date. Under Regulation 685.219, subsection C3, it converts your count to a weighted average. The department's own example is 60 qualifying payments on a $30,000 loan combined with a $30,000 loan at 0 payments, and the result is 30 payments. It does not zero you out. It averages you down. That is a different danger and a more specific one, and it means the arithmetic of what you fold in is what matters. And keep these two separate in your head, because they get confused constantly. This averaging is about your PSLF payment count. It is not the forgiveness clock Marcus lost earlier. That one is the 20, 25, or 30-year clock on your repayment plan. Consolidating averages the first and restarts the second. If you have 120 certified months, but your payment count is short, ask about PSLF Buyback. This can genuinely price out at $0 if your income during those paused months would have produced a $0 payment. 2 deadlines inside it will hurt you if you miss them. When the department asks for your tax and family size information, you have 30 days, and blowing that turns a possible $0 price into the full 10-year standard amount for every month. Once you have an agreement, you have 90 days to pay. And while a buyback is pending, do not submit another PSLF form, do not consolidate, and do not pay off your loan, because those void the agreement and the payments you already made will be credited as regular payments and will not be refunded. One more. Do not resign the day you hit payment 120. You must be employed by a qualifying employer both at payment 120 and on the day you apply. Now let us talk about pushing payments back, because this is what most of you came here for, and the field is full of outdated information. First, the correction that saves the most people the most money. There is a widespread belief that unemployment deferment and economic hardship deferment have been eliminated. That is wrong in a very specific way. The statute, 20 U.S.C. 1087E, subsection F7, says a borrower who receives a loan on or after July 1, 2027 shall not be eligible to defer such loan. Such loan. It is loan level. It is a year away, and it only touches loans you take out after that date. If you already have loans, you keep unemployment and economic hardship deferment on them forever. The same is true of the new 9-month per 24-month cap on general forbearance. Same loan level gate, and it applies only to discretionary forbearance, not to the mandatory ones. Notice how different that is from the repayment plan rules I described earlier. With repayment plans, one new loan poisons your whole portfolio. With deferment, the new rules touch only the new loan. Same law, opposite mechanics, and mixing them up is where most of the panic online comes from. In-school deferment, graduate fellowship, rehabilitation training, military service, and cancer treatment deferment are all untouched. Cancer treatment deferment is worth knowing about specifically because interest does not accrue on any loan type during it. Second correction, and this one runs the opposite direction from what you may have read. There is a claim going around that forbearance no longer capitalizes your interest. Do not act on it. The regulation is explicit. 34 CFR 685.205 says that if payments of interest are forborne, they are capitalized. There is exactly one exception, and it is narrow. The 60-day forbearance the department grants while it is processing your paperwork does not capitalize. Everything else does. That same regulation requires the department to walk you through the consequences of interest capitalization out loud before certain forbearances, which would be a very strange requirement if capitalization had gone away. Deferment is the better instrument whenever you qualify for one. On a subsidized loan in a qualifying deferment, the government covers the interest, so nothing accrues and nothing gets folded in. So the question for your servicer is not, does my interest capitalize? It is, who holds this loan, what type is it, and what will my balance be the day this ends? Get that answer in writing.
But here is the thing that actually matters about forbearance, and it is the reason I would steer you away from it anyway. A $0 income-driven payment and a general forbearance both cost you nothing this month. Only one of them counts. General forbearance appears on neither the crediting list for income-driven forgiveness nor the qualifying payment list for PSLF. A $0 payment counts as a payment. Forbearance counts as nothing. If you can get to a $0 payment, that is a strictly better version of not paying. And over a few years, it is the difference between progress and a hole. One practical warning: do not stop paying the day you mail a deferment or forbearance request. The department says on both pages to keep paying until you are notified it was granted, because if it is denied, every month you skipped is a delinquency. Now, the tax bomb. This is the biggest change nobody has caught up to, and if you are anywhere near forgiveness, it is worth 5 figures. From 2021 through 2025, forgiven student debt was federally tax-free. That came from the American Rescue Plan, and it was written to apply to discharges after December 31st, 2020 and before January 1st, 2026. It expired on its own terms. It was not extended. What replaced it is permanent, but it is much narrower. Internal Revenue Code Section 108F5 now covers only discharges on account of death or total and permanent disability. So as of right now, 20-year income-based repayment forgiveness, 25-year ICR forgiveness, and the future 30-year RAP forgiveness are ordinary taxable income again. A $90,000 discharge that would have been free in 2025 is a 5-figure tax bill in 2026. But do not panic yet, because there are important exceptions, and they are load-bearing. Public service loan forgiveness is not affected. It rides on a completely separate and permanent provision, Section 108F1, and so does teacher loan forgiveness. If you are chasing PSLF, nothing changed for you. Death and disability discharges are permanently exempt, which is what the new rule covers. And while I am on disability, there is a myth here worth killing because it keeps people from applying at all. You have probably read that after a total and permanent disability discharge, you have to submit 3 years of income documentation and can lose the discharge if you earn too much. That monitoring is gone. Under the current regulation, there is exactly one thing that reinstates the debt, and it is receiving a new direct loan or teach grant within 3 years. Not earning money, not getting better. If your discharge came through the VA, there is no monitoring period at all. On the same theme, if a family member has died, a photocopy of the death certificate is expressly sufficient under Regulation 685.212. Servicers have historically demanded certified originals from grieving families, and they are not entitled to. Closed school discharge and borrower defense rest on different authority and were never dependent on the expired provision. And there is a carve-out worth real money. The department has said that if you met your income-driven repayment milestone before January 1st, 2026, but your discharge was not processed until later, that discharge is not subject to federal tax. Enormous numbers of people hit their milestone in 2024 or 2025 and are still stuck in processing. If that is you, you are not exposed. Do not let anyone tell you otherwise. There is also the insolvency exclusion, which is not specific to student loans. If your liabilities exceeded your assets immediately before the discharge, you may be able to exclude some or all of it using IRS Form 982. If you are facing a forgiveness tax bill, that form is the first thing to ask a tax professional about.
What I cannot tell you is what your state will do. I could not verify primary guidance for a single state, so I am not going to name states on screen. What I can tell you is the general shape. Most states start from your federal adjusted gross income, so if it is federally taxable, it is probably state taxable too. Check your own state's Department of Revenue. Now, if you are behind, this next part is the most important thing in the video. The ladder works like this. Credit bureau reporting starts at 90 days delinquent, and that record survives everything you do later. At 270 days, you are in technical default, but the department reports default at 361 days to stay consistent with old FFEL reporting. That gap is real and it matters, because you can be in default while your dashboard still says delinquent. 9 million people are in default right now, more than 13% of the federally managed portfolio. That number went from 5.2 million to 7.7 million to 9 million in 6 months. If you are there, you are 1 in 5 borrowers. This is not your personal failure. The credit damage is measurable. The New York Fed found that borrowers who actually went into default dropped 91 points on average, from 567 to 476.
That is the cost of avoidance in the one currency everybody already understands. If you are less than 90 days behind, cure it now, before it is ever reported. If you are between 90 and 270 days, get onto an income-driven plan immediately at studentaid.gov/IDR and consent to the IRS data sharing so it processes. If you are already in default, you have real options, and which one you pick depends on what you need. If you need your credit repaired, choose rehabilitation. 9 voluntary payments, each made within 20 days of its due date across 10 consecutive months. The payment is set at what you would owe under an income-driven plan, and if that works out below $5, $5 is the floor. For a lot of people, it really is $5 a month, $45 total to get out of default. But know what that number actually is. It is a reasonable and affordable determination based on your total financial circumstances, not a price on a menu. The first figure a collection agency quotes you is not necessarily that determination. If what they name is impossible, say so and ask them to put the reasonable and affordable amount in writing. And rehabilitation clears the default off your credit report. The department has to tell the credit bureaus to take it off. It does not remove the 90-day lates that came before it, but the default itself comes off, and consolidation will not do that for you. One thing to check first. If your school shut down while you were enrolled, or it signed you up when you were never eligible, there are discharges that wipe the whole thing, late marks included. Those beat rehabilitation. Ask about closed school discharge before you start making payments. 2 warnings on that. It is once per loan, and a second rehabilitation is not available until July 1st, 2027. I have seen people say you can rehabilitate twice now. You cannot. Not yet. And the minimum payment rises from $5 to $10 on that same date for direct loans. If you need speed instead, consolidation out of default is faster and can be done online. But the default stays on your credit report. Interest capitalizes, collection costs attach. And remember the whole first half of this video, because after July 1st, 2026, a consolidation lands you on wrap and nothing else. There is also a gate on it that catches exactly the people in this segment. Under Regulation 685.220, you cannot consolidate a loan that is subject to an order for wage garnishment, unless that order has been lifted. Note the word order. A notice is not an order, so if nothing is coming out of your paycheck yet, this door is still open. One more reason the 30 days matters. If what you actually need is to go back to school this term, there is a separate and much shorter path that almost nobody knows. 6 consecutive, voluntary, on-time, full payments restores your federal student aid eligibility. 6, not 9. It is in Regulation 685.102 under Satisfactory Repayment Arrangement, and it is a one-time benefit. And if there is already a judgment against you, neither rehabilitation nor consolidation is available. That is a lawyer conversation. Now the envelope. If a garnishment notice arrives, everything comes down to one number, and it is 30 days. Administrative wage garnishment lets the government take up to 15% of your disposable pay with no judge, no lawsuit, and no court hearing. That is the fact that shocks people most, and it is true. But the 30 days is your leverage. Under Regulation 34 CFR 34.11, if you make a timely written request for a hearing, the department will not issue a garnishment order before providing that hearing and issuing a written decision. Not delay it, not reduce it, will not issue it. A timely request stops the whole thing before it starts. So here is how you send it, and it costs nothing.
Your notice names the office to send it to because the regulation requires it to. You do not need a lawyer and you do not need a special form. A letter is enough. Write that you are requesting a hearing, put your name and your account number on it, say what you are objecting to, and mail it to that office certified mail with return receipt. Keep the receipt because that receipt is your proof of the postmark, and on a loan the department holds, the postmark is what makes you on time. Miss that window and the character of your situation changes. Once the order is outstanding, Regulation 34.24 generally bars a hardship hearing for 6 months. And if the garnishment has already started, if money came out of your last check, this next part is for you, because so far this section has been about stopping an order before it is issued, and yours already was. Rehabilitation still works while you are being garnished. No two things going in. The money coming out of your check does not count toward the 9 payments because the regulation requires those to be voluntary, and garnished wages are taken rather than paid. So for about 5 months, you are paying twice, and there is no way around that. Here's what you get for it. After your 5th qualifying payment, the department has to rescind the order and tell your employer to stop. Not the 9th, the 5th. Call the Default Resolution Group at 800-621-3115 and start that clock this week. Now here is a distinction I have not seen made anywhere, and it can cost somebody their automatic stay. The department accepts a postmark by day 30. A guarantee agency, which is who holds many older FFEL loans, requires actual receipt by day 30. Same 30 days, 2 completely different rules. If a guarantee agency holds your loan and you mail your request on day 30 relying on the postmark, you lose. A few more things that are yours by right. Disposable pay is not take-home pay. Under Regulation 34.3, it is what remains after your health insurance premiums and anything required by law to be withheld. So your premiums do come out first, but a voluntary 401k contribution does not. Calculate it correctly because almost every garnishment calculator online uses the wrong definition. There is a floor protecting the equivalent of 30 times the minimum wage, about $217.50 weekly. If other garnishments already exist, the combined cap is 25%. Your employer cannot fire you for a single student loan garnishment, and that is federal law. And this one is invisible unless you claim it. If you have been involuntarily separated from a job and have been back at work for less than 12 continuous months, they cannot garnish you at all. Nobody will volunteer that. You have to say it. And you say it in writing, in that same hearing request. Put in the date you were laid off and the date you started your current job, and say plainly that you have been back at work less than 12 months. And if a notice has actually arrived and you would rather have the letter than the summary, I built one. It is called the Garnishment and Default Defense Pack. It is the hearing request itself with all 3 grounds already drafted: the involuntary separation claim and the evidence list that backs it up. A worksheet that runs the disposable pay math the way the regulation actually defines it. A hardship statement built against the same standards the department measures you against. And the phone scripts for the rehabilitation call. $39, and the link is in the pinned comment. Let me be straight with you about what it is. It is templates, worksheets, and scripts. It is not legal advice, and nobody can promise you an outcome here. What it does is make sure the protections you already have get claimed, on time, in writing, with the documents attached. If your 30 days is running right now, that is the whole ballgame, and you should not be spending it drafting. On Social Security, there is a myth that needs killing. People say they can take 15% of your check. The actual formula is the lesser of 15% or the amount above $750 a month. Treasury's own example is an $850 benefit yielding $100 and a $650 benefit yielding nothing. Supplemental security income is fully exempt. That $750 figure has not been adjusted since 1996. It was about $100 above the poverty line then. It is nearly $600 below it now. The 2026 guideline for a single person works out to about $1,330 a month. And here is where I have to be careful with you, because the current situation is genuinely unstable. As of August 2026, the department says Treasury offset and administrative wage garnishment are paused. That pause started January 16, 2026. The department also said in July 2025 that it had not actually withheld Social Security payments since restarting collections, despite a lot of reporting that told seniors their checks were about to be taken. But do not hear that as protection. There is no announced end date. The department can lift it without any rulemaking. The page announcing it is already flagged as historical content. Credit reporting never stopped. And critically, if a guarantee agency holds your FFEL loan, the pause does not appear to cover you at all because Regulation 682.410 still requires those agencies to pursue garnishment. Treat this as a window to fix your default, not as a reason to relax. One last thing about federal loans that people get wrong. There is no statute of limitations. 20 U.S.C. 1091A eliminated every limitations period. A 30-year-old default is fully collectible. Private loans are different, and if you are sued on a private loan, show up to court because a judge can enter judgment on a time-barred debt if you do not appear and raise it yourself. Before I close, let me give you the money nobody mentions because every item here is free and none of it is on any other video about this topic. Your employer can pay up to $5,250 a year toward your student loans, tax-free to you under Internal Revenue Code Section 127.
That provision is now permanent and indexes for inflation starting in 2027. It is the most underused benefit in this entire topic, and the only one your boss can simply decide to give you. Ask. Under Secure 2.0, your employer can match your student loan payments with retirement contributions. You get retirement savings for paying your loans. Enroll in AutoPay. The interest reduction went from 0.25% to a full 1% on July 1st, 2026, and it runs through June 30th, 2028. On a $60,000 balance, that is around $450 a year. But the enrollment deadline is 11:59 p.m. Eastern on September 30th, 2026. And it applies only to direct loans originated after July 1st, 2012. Not FFEL, not Perkins. Of every deadline in this video, that is the only one that lands while you are still deciding what to do. If you served, the Service Members Civil Relief Act caps interest at 6% on debt you took on before service. There is also a separate 0% interest benefit for up to 60 months, but it is narrower than people think. It applies only to loans first disbursed on or after October 1st, 2008, and only while you are serving in an area of hostilities that qualifies for special pay. And if you work in a health shortage area, the National Health Service Corps pays up to $75,000 for full-time primary care, plus a $5,000 Spanish language enhancement, so up to $80,000. One warning, that is tax exempt. Nurse Corps repayment is not on the same statutory list and is taxable. A 60% award on a $90,000 balance is roughly $54,000 of taxable income, and nobody warns people about that. So here are the 5 permanent mistakes. The one-way doors. Do not refinance federal loans into a private loan. It is the only truly irreversible act in this entire topic. You forfeit income-driven repayment, RAP, PSLF, disability discharge, death discharge, borrower defense, closed school discharge, rehabilitation, consolidation out of default, the unemployment garnishment protection, and the collections pause. There is no path back. Ever. Do not take any new federal loan, including a new consolidation, if you currently have income-based repayment, pay, or ICR. One disbursement reclassifies everything you own. Do not let the 30-day garnishment hearing deadline pass. It is the only window where a piece of paper stops the whole machine. Do not consolidate to tidy things up while chasing PSLF. Certify all your qualifying employment first. And do not pay anyone a fee. Every program in this video is free at studentaid.gov. The FTC brought a case in April 2026 against an operation charging up to $1,400 a month, and another in July 2026, ending in a $45.9 million judgment that was partially suspended because the defendants could not pay. Even when the FTC wins, your money is usually gone. Now let me tell you what I do not know, because on a topic like this, the gaps are the credibility. I cannot tell you for certain whether a defaulted borrower can enroll in income-based repayment or RAP right now.
The regulation says defaulted loans are eligible. The department's own website says they are not. And a March 2026 court order sits in the middle. Call the Default Resolution Group at 800-621-3115 and get the answer for your file in writing. I do not know whether the department has appealed the PSLF ruling. It was vacated as of the making of this video. Durability on appeal is unknown. I do not know when collections resume. Nobody does, including the department. Check the banner on the collections page at studentaid.gov before you make any decision that depends on the pause. And I do not know how your state will tax forgiveness, which is why I did not name any. If you take one thing from all of this, take this. Whenever a rule turns on a date, say the words "first disbursed" out loud and go check. That single habit prevents almost every expensive mistake in this entire subject. I've put a full written breakdown of everything in this video at fasa-appeal.com, including the decision tree, every regulation cited here, and the deadlines laid out in order. It is free, and it is updated as this keeps moving, because it is going to keep moving. And if you are the one with a garnishment notice sitting on the counter right now, the Garnishment and Default Defense Pack is linked in the pinned comment. Everything I taught you in this video stays free on the site. The pack is the paperwork, already written, for the person who has 30 days and does not want to spend them at a blank page.